Ted, let's talk about Facebook. This company doesn't need any introductions.
So yes, Moeed, I was checking out Facebook. We were obviously discussing it the other day, and every time we talk about any company, my instinctive reaction is to go and look at the financials. So here we are on the investor relations tab of Facebook, where you find the financial reports. And I noticed in the annual reports down the bottom that the latest set of annual reports was 2018. Now it's very easy to find these. You just type in Facebook annual reports into Google, and we'll take you straight to the page. They should have filed 2019, so I'm not sure why 2019 accounts are sitting on the website. Still, not to worry. You'll see up at the top here we've got the quarterly earnings. And I'm doing a little bit of digging into these quarterly earnings. So here we've got a balance sheet and an income statement for Q3 2020, and those include 2019 numbers. So as far as I'm concerned, because they're in a spreadsheet, they're not audited. And so if they're not audited, there's always a potential they're going to change. Until I get hold of that 2019 account, we're dealing with unaudited figures. Anyway, so let's look at 2018 figures. So there is the income statement. What do you think of that, Moeed?
Wow.
So here, this company, let's look at this in a little bit of detail. This company, revenue, $55 billion.
Yeah, the first thing that leapt out to me is the cost of revenue.
28 billion, 41 billion, 56 billion. Okay, this company is going straight up, isn't it, in terms of growth? And the cost of revenue is nothing.
Yeah.
What does Facebook sell?
Space for advertising, almost.
Absolutely. What does it cost them to sell that space?
Yeah, nothing.
Nothing.
It's already
exactly.
there. The platform's already existing.
A couple of blokes in mum's attic running some servers. Okay, it's a little bit more than that. So what's interesting is this is the cost of the space that they're providing, the cost of that advertising. These are the sales guys. So the cost of selling it and marketing. I'm not sure you really have to market Facebook that much. And then very small general administrative costs. So this is kind of cost of servers, rent, rate, light, heat, all that kind of stuff, HR, finance, all the kind of, the stuff that every company has to incur. You'll also notice this is quite an interesting one. Lots being spent on research and development. Okay, Facebook know they can't stay still. Are you on Facebook, Moeed?
Not really, not anymore.
Not really, a little bit. Okay, I'm on Facebook occasionally. Hashtag my life is better than yours, all that kind of stuff. But my kids aren't really. There's a little bit of it, but it's not really. They're kind of their Instagram, and I think TikTok seems to be a big thing at the moment, and all that, So that's kind of driving them. So Facebook know that maybe, it's a fickle world, and they've got to stay relevant, so that they are investing in research and development. What's going to happen next, effectively, and that's effectively this line here. So that's and they can afford it.
It is quite a high R&D intensity. I mean, I come from a background where we used to advise companies around R&D, and just over 15%. That's quite high, even for their industry, actually.
Absolutely, it is a high amount. It's 15 to 20%. But they're expensing it. They're not. Lots of companies might capitalize that. They're expensing it, so they're just investing in. They know that the future is going to change, and they're investing in that future. And that's good. It's a company they can afford to do that. Even with that, they're making an operating profit margin of about 45%.
Yeah.
Okay, so that's this number here, the 25 billion. Operating, so income from operations is what they call it. It's actually a operating profit, and that percentage of the sales is 25%. So they are generating lots and lot of profit, which is fantastic. I think last time we spoke about Thomas Cook. These guys have no Thomas Cook problems. Why? They've got no debt. So Facebook is no debt at all. They're paying some tax. And the rest is the profit. So this net profit, the bottom line, 40%. So here's the balance sheet. So what have we got? So here's the kind of current assets. These are things which are cash or going to become cash soon, which is basically all cash. If you remember, these marketable securities, these are bonds issued by companies and governments. So effectively, this is a way of a company like Facebook that has lots of cash of parking in an investment. Okay, so it's a kind of short-term investment which they can sell. Well, they could sell it tomorrow because the bond market is open. So when I see marketable securities, it's another word for cash. So Moe, these guys are pretty close to Pablo Escobar. You may remember Narcos and Netflix, for example. Pablo Escobar, he makes so much money, he doesn't know what to do with it. He's just burying it in the ground. Well, Facebook don't need to bury it in the ground, but they are making so much money, they almost don't know what to do with it. They've got $40 billion sitting in the bank. You'll notice they've got quite a lot of property, plant and equipment. Kind of surprising because you wouldn't expect a company like Facebook to need that, but they don't need it, but they want it. So they've obviously bought some very nice buildings that they're going to run out of, sort of, you know, they'll have Facebook campuses, for example, and, you know, and they can afford that. Goodwill is the difference between what you pay for something and the net asset value.
Right.
So if you buy a company with, let's say, assets of 5 and it's got liabilities of 2, the net assets are 3. That's what you're buying. But if you pay £100 for that company and you get £3 of net assets, then the goodwill is £97 in that example. So it's effectively, because you're buying the income or the potential of a company, you pay more than the net asset value. And what this tells us is that Facebook has been buying other companies, and that's part of their business model. So their business model recently has been very much, you either buy the competition. So if you sit in California and you invent something that's going to threaten Facebook, they'll just buy it from you. And they'll buy it from you for, I don't know, $1 billion, for example, and you'll be very pleased because you've sold your unicorn. And Facebook will either kill it because they don't want it, or they will use it. So think about WhatsApp, for example. You know, they bought WhatsApp. Now, I can't remember what they spent on WhatsApp, but it was billions. I mean, it was a lot of money.
$9 billion.
Where did they get the money from?
From their share listing.
Well, they could have gone to the shareholders, or they could have raised money through debt. But actually, again, you notice they've got $40 billion in the bank, and that allows Facebook just to buy. They don't have to justify it to the shareholders. They don't have to justify it to the bank. They've got the money. They can just transact. They can just buy companies when they decide to.
Didn't they get a big influx of money? And then that's when I thought they used that money to buy WhatsApp.
They will have used some of that money to buy WhatsApp, but today, right now, they are buying companies. Right. And the point I'm trying to make, Moed, is that they've got a lot of cash.
Yeah.
Do you have any cash on you?
Yes, not 40 billion, but I do.
Yeah, not 40. Yeah. And you hold cash for 3 reasons. You hold cash for transactional purposes. You know, you have money in your pocket, so you can pop down to the local supermarket and buy yourself a pot noodle for lunch, for example. You have cash for rainy day purposes. So perhaps as you're going down to the supermarket, you notice one of your shoes has got a hole in it. You're letting water in, so you now need to go to the local shoe store and buy yourself a new set of shoes. Okay, so your rainy day purposes. You also hold cash for speculative purposes. So on the way to the shoe shop, you notice that there's a half price sale going on for Anya Hindmarch handbags. They're down from £2,000 to £1,000 each. And you think that's a bargain. That will be perfect for Mrs. Moed and her birthday. So you have the cash to be able to take advantage of that speculative. Okay. Now, Facebook is holding a lot of cash, and a lot of that cash, you know, transactional, they don't need very much cash. Rainy day, possibly, but there's a lot of speculative cash sitting there. So holding that cash so that they don't have to ask the shareholders or the debt providers for permission to actually go and buy other companies. So that's quite interesting, looking at the top half of their balance sheet. If we look at the bottom half of the balance sheet, the liabilities, the first thing we know with notice with the liabilities is that the total current liabilities is very small compared with the current assets. Okay, so these guys, I mean, liquidity is just not a problem. You know, they don't lie awake at night wondering, can I pay my bills on time? They've just got cash flooding into the business. They can, I mean, look at the accounts payable. It's
Yeah.
basically nothing. You know, I mean, they're just paying their suppliers. Yeah. And so they've got some very good will with the suppliers. There's a little bit of accrued and other expenses. It's really not an issue. And you also notice is that the total liabilities, there's no debt there. They just
No.
don't have any debt. And so, you know, this is the opposite end of, you remember, we were talking about Thomas Cook. Thomas Cook, low margin business, had to buy the holidays, to sell the holidays. They'd grown through debt. They couldn't afford that debt. They were kind of creaking. They were sort of staggering forward. I mean, why anyone would be an investor in that, I'm not sure. These guys are just, you know, they are absolutely flying. It's a really nice, strong company. And the last thing to look at, there's the income statement. The last thing to look at is their cash flow. So we'll just bounce down to their cash flow, and we see that the profit that they're making, there's the profit. And as we'd expect, they're generating lots and lots of cash. So very, very, very strong cash generation, nearly $30 billion in 2018. So those are the numbers we've just been looking at. We're looking at the income statement here. The figures I showed you, the kind of quarterly earnings reports I was showing you, they've got 2019 numbers in. So I've extracted the 2019 numbers here. I put a little question mark because they're not audited. So they're not kind of final, definite, you know, the definite numbers, but I doubt that they're going to change. Here's Q3 for 2020. So that's up to the end of September. And because they haven't released the final set of accounts, they haven't had time to, you know, obviously we're in January 2021 right now. I've put in a forecast. Now, my forecast, I'm not a professional analyst. So all I've done is I've just taken this and multiplied it by an additional quarter. So I've kind of said, if you can do 58 billion sales in 9 months, you can do 77 billion of sales in 12 months. And so you'll notice that these percentages are all exactly the same.
Yeah.
So what do we see from this? What are our conclusions? We see that it's making lots of money. Net margin 30% is still absolutely phenomenal. A lot of R&D in there, Moeed. Still a lot of R&D in this this number here. Okay, so in this operating costs.
Yeah.
So without that R&D, it'd be even more profitable. What else do we see on the balance sheet? Again, the balance sheet is still looking really, really strong. Look at that balance sheet. Look at the relationship between the current assets and the current liabilities. It's just, you know, liquidity is just not a problem. They're just holding tons and tons of cash.
I mean, this is a very healthy business.
Absolutely, very healthy business. The debt is negligible. They do have a little bit of debt, but nothing to write home about. It's really not an issue. When we run these numbers, it's just a company which is financially really, really, really strong. Okay. Now you may remember we looked at Tesla. Tesla, you know, it's profitable, just profitable. Whereas Facebook, you know, very profitable, very cash generative, getting to a mature company. We actually notice in the cash flow that they're starting to buy back their own shares. Here we go. So you see the purchase of common stock. So this is a way of returning money to the shareholders. You remember Class A stock. This is what you and I buy, okay, but it doesn't have any voting rights. So the question is, I guess, what's the company worth?
Yeah.
Well, if we look up the share price, and I pulled this off yesterday, so it's out of date already, we notice that it's 268 to about $269 per share. And the total market capitalization is $765 billion. So there's a P ratio of about 31, 32. You're paying about 32 times earnings. Okay. and the market cap is about 76. I looked on another website, it said 78. So it's kind of, it's about that. It's, you know, seven, you know, hey, what's a few billion between friends, Moe? Don't worry about it. So the P ratio of 31, if you turn that upside down, that's a yield of 3%. Okay, so if Facebook doesn't grow at all, it's like earning 3%. Now you're not going to get 3%, return to, because they're not paying dividends, but it's the equivalent of that. You know, those earnings have to go somewhere. Do you remember Tesla's P ratio, Moeed?
1,000, just over 1,100, I believe.
Yeah, well, yesterday I looked at it, it was 1,663.
Oh gosh.
So if I give you a choice of buying a company which is only just profitable and you pay 1,600 times earnings, or I give you a company like Facebook, which is generating more cash than you and I will ever see, and it probably generates that in a day more than you and I will ever see, and I give you the chance to buy it 30 times earnings, 32 times earnings, where do you think you're going to put your money?
Yeah, well, obviously Facebook, it's more reliable.
Absolutely. And full disclosure, Moeed, I am an investor in Facebook, and I am not an investor in Tesla. Even though since we last spoke, Tesla has gone up in value. The
I know.
price is still going up. I mentioned the goodwill, so we can actually look at the inherent goodwill. You may remember that if we look at the balance sheet, here's the balance sheet. The NAV is the net asset value, so that is this number here.
Yeah.
Okay, now the net asset value has actually increased to 117 to 118 million. So that is effectively the net. So if you take Facebook in the third quarter 2020,
billion, sorry, 118,
and you
118
sell
billion,
it,
right?
yes, 118 billion, thousand million. So if you were to liquidate Facebook, and this is obviously theoretical, you'd put all the assets on eBay, and you'd raise, you know, the total amount of assets. You'd have to pay off the liabilities. So what you're left over with is 117 or 118 billion. And so, you know, and I've been looking at the 2018 figures, which was 84. So even if it's 118 billion, the value of the company, the market value, the total market value is 765.
Right.
765 less the net asset value effectively gives you what we call the goodwill, and it would be the goodwill inherent. So comparing this to 2018 figures, there's 684 billion. Comparing it to the goodwill for the latest set of accounts, you're looking at whatever that is, about 650 billion. So 650 billion of goodwill, you're paying 650 billion more than the net asset value. What's that? That's about 8 times the net asset value.
Right.
Less than that, 6 times the net asset value.
Right.
So you're paying a premium, but you'd expect to pay a premium because this isn't an asset company. This is a trading company. This is a company that just generates cash. So, you know, shares can go up, shares can go down, but you know, I kind of feel that Facebook, it's not cheap, but it's not overly expensive. I kind of feel that, you know, it's a reasonable investment. Now, I may be wrong. They may mess up. Everybody may suddenly find there's a new technology thing and everybody's on that, and Facebook completely falls flat on its face.
Yeah.
I kind of feel that, you know, looking at the company, the investment they're making in R&D, their acquisition activity, they're very dynamic. Have you heard of Libra?
Yes.
Okay, so Libra is their potential cryptocurrency that they were kind of muting. They've kind of taken it off the shelf, I think, recently because they've got a few regulatory issues, and you know, they sort of need, you know, they need to sort out their regulation and their brand image before they start producing their own currency and really start to upset the authorities. But you know, Libra, think how many people have Facebook accounts but don't have bank accounts. You know, probably less so here in the UK. But you think about, you know, the Indian subcontinent or the African subcontinent, that's a massive potential market. So as soon as they started talking about Libra, I thought I'm gonna take a stake in this company.
I mean, they could become almost the equivalent to Amazon for those regions, because then they can really push their marketplace through the platform.
Absolutely. I mean, I think you're right. You know, they are playing in the kind of the, you know, they are definitely looking at that, and they're much more profitable than Amazon. Amazon's sales are much higher, but Amazon, every time Amazon sells something, has to buy something. Don't forget, we've got the network effect here. The network effect does not exist at Tesla. Okay,
No.
it doesn't exist at Uber. It doesn't exist at Dashdor or Deliveroo. Okay, Deliveroo and Dashdor are competing against each other. And I don't care whether my pizza is delivered by one or delivered by the other. I'll go for the cheapest. And I'm a bit of a, you know, a kind of a price tart on that basis. But Facebook, I'm on Facebook because my friends are on Facebook, and they're on Facebook because I'm on Facebook. So it's got this network effect. It's a very strong effect. It's very difficult to leave. And that's a really strong economic moat. Coca-Cola, they've got the brand. Facebook, Apple has an ecosystem. Facebook has this network effect, and it's very, very strong and endearing. And I think that is where, you know, that's where Facebook, you know, really shows its value on a sustained basis.
That's really interesting, very interesting, because I always knew that Facebook were profitable and very profitable, but it's good to see the numbers behind that, and particularly what they're doing with R&D, because that gives you a little bit of a sense about the business there. They know that disruption could come around the corner, and they have quite a bit of an R&D culture in their business, right? 15% R&D intensity is a large amount, even in comparison to other tech businesses. So it certainly gives you a sense about the company. This was very interesting indeed to cover Facebook.
And just one other thing is that I mentioned regulation, Moeed. Regulation is quite interesting because they want regulation, because regulation creates barriers to entry. It makes it very difficult for you and I to set up an equivalent of Facebook if we have to pile through tons and tons of red tape. So Facebook have got to a stage where now they say, let's have regulation in, because they can afford to actually, you know, have the you know, employ the people to do the regulation, and it helps to protect their position. So what we suddenly find is that whereas the regulators start to move in and start to, you know, we think, you know, they're doing a good job, what they're basically doing is helping Facebook create an even bigger economic moat.
So that's interesting, right? Let's just cover that for a second, because you're saying that the regulation actually stops competitors from entering into their space. But let's talk about this for the perspective of the viewers. Regulation, particularly in Europe, they're also designed to prevent Facebook from taking too much of a market share as well, and allowing competitors some form of entry as well. But you're saying the opposite. Can you talk a bit more about that? Because it should be the other way around. Sure.
So when we think about, so let's think about two different types of regulation. So if Facebook buys WhatsApp, then you have a mergers regulatory authority body who will say, you know, does that mean that you know, there's less competition, and if there's less competition, therefore they can increase their pricing. So for example, a water company has regulators who make sure that they don't charge their customers too much, because I need water and there's only one company I'm allowed to buy it from. It's effectively a monopoly.
Yeah.
But the regulation I'm also talking about is Facebook responsible for the material that's published on its platform? Now, if the regulator says yes, it is, then Facebook has to employ people to go through the platform to make sure that anything which is, you know, which is illegal, whether it's, you know, from a sexual nature or from a defamatory nature or from a fake news nature, they have to employ people to trawl through the content, or they have to develop the algorithms to trawl through the content to identify and take it down. Now,
Right.
if you and I are setting up Facebook, the last thing I need to be doing is to trying to employing people and writing these algorithms when I'm trying to launch a brand new network as well. So what you can start to see is it's a bit like banking. Banking is a really difficult world to get into because you need a license, you need capital, but you also need to tick a lot of regulatory boxes. So banks are effectively a monopoly because it's very difficult to get in there. Coca-Cola, it's very difficult to get in because of the brand. It's very easy to create. You and I can start creating cola very, very easily, but we can't compete with cola because of the strength of their brand. We can't compete, sorry, with Coke because of the strength of their brand. We can't compete with HSBC because of the regulation required. Facebook we can't compete with because of the strength of the brand, the network effect, and the regulation, the regulatory requirements, which altogether is making it really, really strong from their economic moat, from their perspective.
Very interesting indeed. And this was very valuable to go through, because we've got an idea of their finances, we've got an idea of where they're spending that money, we've got an idea of they're holding money, which seems like for the third reason, which is the speculative, as you say, and their share price. We've got an idea of, is it? And by the way, just for the viewers to mention, share prices have a huge number of factors involved. We're just looking at this from a financial perspective, not from all the other dimensions that can affect share price, but from a financial perspective, it looks like a sensible deal.
You're absolutely right, Moeed. And just one thing I will give a kind of caveat is that when Facebook floated back in 2006, it floated on a P ratio of 100. And PE ratio of 100, I looked at it, I thought that's really expensive. And I did not buy shares. Now, Moeed, was that the right decision or the wrong decision?
Well, in hindsight, it was the wrong one.
You're right, it was the wrong decision because the share price has gone up very, very significantly since then. So I'm not saying I get it right. I don't get it right the whole time. If I had put a substantial, if I'd sold my house and put it into Facebook in 2006, I wouldn't be sitting here. We'd be speaking, but I'd be on my super yacht somewhere in the Caribbean. So I don't always get it right. It is a much more expensive company today, but the PE ratio, so the potential has come down, but it's still a really good, strong, solid, growing company making profits. And I can't really think of a lot that's gonna blow it off course.
So Ted, thank you. This was really, really interesting. And if anyone wants to check out the Facebook financials for themselves, just type in Facebook Investor Relations in Google, and you'll find the page there. In fact, you can do that with any public company. Just type in the name and type in Investor Relations. You'll get access to all the regulatory filings, including the annual report and the quarterly earnings. So Ted, thank you again for a very interesting walkthrough of a very interesting business.
It was a pleasure, Moe. Good to speak to you.
Cool.